We will now focus on the European market. We're predominantly going to be focusing on the DAX. I put DAX 40. I know many publications will say DAX 30, but there are now 40 constituents in the actual index. So we will be delving into that. We won't be looking into the French, Italian, or the Spanish markets. We're only really looking to focus on the markets which are going to have an impact on your clients and areas in which they may want to focus their investments in. Okay, now we're going to focus on the German exchange, the Frankfurt Stock Exchange. We won't go into too much detail like we did with the London Stock Exchange, but we will be focusing on the DAX as well as its sectors. But more importantly, I want to touch on the economy as a whole. There's a reason why I've not involved, the French, German, or the Italian economies or markets within my course here. We want to focus on the largest economy in Europe, which is Germany. Now, your job as a broker is to be educating investors, keeping them up to date with information and data, what's happening globally. So you need to be in a position to understand how Germany's economy is improving, how well their market is improving, and how much of a correlation is that with where your current clients are and their portfolios. So when we talk about Germany, they are the largest economy in the is one of the largest economies in the world. They are the largest here in Europe, and that is predominantly based on their GDP. They are very diverse industrially, as well as a very big exporter. So when we talk about the exporting nature, we're talking about their cars, their machinery, their chemicals, and other manufactured goods, engineering as well. So it is a hub of innovation, Germany. So as long as they keep improving and they keep doing well, that will naturally spur the European markets potentially higher. Now, the Frankfurt Stock Exchange, where the DAX resides, is one of the largest exchanges globally. Okay, and that's all you really need to know about it. But when it comes to the DAX, I put the DAX 40. You do still see it as the DAX 30, but there are 40 companies or constituents within the overall index. So bear that in mind. It is a market capitalization weighted index, just like the LSC. Okay, and the market hours for trading are between 9 and 5:30, so very similar opening times. Well, they're an hour ahead, so it's the same opening hours, they're just an hour ahead. And second of all, there are auction call periods and closing auction periods as well, so it's not just isolated towards the London Stock Exchange. Now, when it comes to sectors, as mentioned, they are based on market capitalization. So there are typically your usual sectors. Cars and parts tend to be one. Companies involved in manufacturing and distribution of cars or car parts is very well represented within the DAX. You will have chemical sectors, consumer goods, and financial services. Obviously, you got the large banks, Deutsche, just to name one, and they're heavily focused within the DAX, as well as asset management firms. Healthcare, industrial goods, and a lot of technology companies will be within the DAX. You will still get the element of beta when it comes to the index. There will be high and low beta companies, as utility firms are represented quite significantly as well, which is, when I say utility firms, I do mean renewable energy, water, electric. Those companies are very well represented, so you will still get high and low beta, so you still can diversify across risk within that index as a whole. But yeah, look, just to conclude, I want you to be very focused on the data and the news that comes out of Germany, as that will play a big part in not only your pitch, but making sure your clients are well updated. Who would invest in the DAX? Now, It's going to be very similar to the London with the FTSE 100. You will get your traditional retail, institutional, and international investors. Now, the retail investors will be the likes of you and I. You can have a long-term, short-term, or an income based strategy, and you can achieve that while investing in the DAX. When it comes to international hedge funds, pension funds, asset managers, they're always focused quite heavily. Remember, institutional investors, they are the bigger players when it comes to the movement of the market, not necessarily you and I. And then internationally, we can have exposure within the DAX at any stage. We can buy companies, we can sell them, that's absolutely fine. But if you're speaking to an investor and you want to expose their portfolio internationally, one option will be to buy individual companies which are on the DAX, which is absolutely fine. Alternate options will be investing in ETFs, tracker funds. So we always believe you should only be advising or investing in stocks or markets that you can visibly see and track. If you don't have a lot of information on the companies which are trading within the DAX, it's not very fruitful, as you can easily be caught out. So we do suggest, if you are looking to focus on markets outside of the UK, research has to be important. But international investors, help massively with regards to the liquidity. The markets in general are very liquid. You're not going to be susceptible to massive forms of gapping, as a lot of these companies are massive in size, very high market cap. Okay, we'll go into the pros and the cons of investing within the DAX for us here. One, if we focus on the positives to begin with, the growth is naturally one thing that many investors always tend to focus on. These are prominent blue chip companies. They're known for their strong market position, very stable earnings, track record, as well as, the option of dividends. So investing in established companies will provide a lot of stability and growth as well. Diversification is one that you may want to focus on. Is not necessarily just diversifying across different markets, globally. It's also focusing on different sectors. This now includes, cars, for example. We don't have an automotive sector within the FTSE 100, so it would be a great option of investing in cars, maybe. Technology companies. We know we've got some form of technology companies in the FTSE 250, but if we're looking for really large market cap tech companies outside of investing in the Nasdaq, for example, you may want to look at the DAX. So it's a great way to diversify clients' portfolios and just really have a broad cross-section of your portfolio. Global exposure, it goes hand in hand with diversification. If you are looking for exposure to international operations and you want to get some revenue from outside of the UK markets, this is one option. Like you said, like I mentioned, markets are not necessarily correlated in the same way. Just because the DAX is up doesn't mean the FTSE always has to be up, or even if they are up together, one may be up more than the other. So you can expect different returns from investing in multiple regions outside of the UK. Now, liquidity, that's naturally part and parcel of a largest index in the Frankfurt Stock Exchange. You've got a huge amount of buyers and sellers. It does ensure that investors can buy and sell with ease. There's always going to be competitive prices. There's not going to be a huge amount of impact onto prices, if anything, even if data came out worse than expected. So you will always have that liquidity where you can enter and exit at any time. The DAX is seen as a benchmark for performance. Investors will use the DAX as a reference point to evaluate any portfolio performance, especially if you're exposed massively to German stock. Okay, but like like I mentioned in the previous slide, one way of getting exposure to the German market instead of individually investing is in looking at exchange traded fund tracker funds, for example. That would be one option you can look at where you would benefit from the broader market movement. Now, when it comes to the cons, there will be natural market volatility. This could be based on geopolitical events or investor sentiment. It could lead to rapid fluctuations or uncertainty, but as mentioned, it has to be significant. One of the key differences between the DAX and the LSE, or the DAX and the FTSE 100, is the concentration risk. You got to remember that DAX is heavily weighted towards 40 companies to begin with, and then second of all, certain sectors such as cars, finance, and tech, they tend to be the overriding sectors within the DAX. So a significant portion of the companies or the index's performance is driven by few sectors. This can make it very vulnerable, especially if these sectors are isolated by way of impact of global events. So you could be affected quite dramatically. Investing in the DAX will carry currency risk, especially if you're outside the Eurozone, or even still within the Eurozone, to be fair. You will be exposed to currency risk. Any sort of fluctuation in the value of the euro relative to whatever currency you're using, such as sterling, can affect your returns, and converting profits or dividends back into your own currency can be rather difficult. Now, there is always going to be a geopolitical risk. Germany's economy and stock market is influenced by many factors such as trade tensions, political instability, conflict within any regions. So any sort of uncertainty will lead to volatility in the market, impacting investors' confidence, and therefore asset prices will fluctuate quite dramatically. We are now going to be focusing on US markets in particular. The S&P will be the one we kick off with right now. We'll now be focusing on the S&P, which is a Standard & Poor 500. We will examine the index and, more importantly, how clients can benefit from having exposure in the US. But as we did with the DAX, I just want to touch upon the economy as a whole, as that's going to be the key reason for you wanting to expose clients or invest within the US as a whole. As you know, the US is the largest economy in the world in terms of GDP. Its economic output represents a substantial portion of the global economy, making it a key driver for global growth as well as overall prosperity. American consumers, they have a significant purchasing power, and their spending habits influence a lot of global demand for not only goods but as well as services, and that does impact businesses and economies throughout the world. So if the US start to struggle and they're not performing as well as we need them to, it will have a knock-on effect, and it will naturally bring global markets as well as economies that bit lower. Now, the US dollar serves as the world's primary reserve currency, widely used for international trade, finance, FX, commodities. Its status as a global reserve currency gives the US significant influence over the international finance markets and facilitates a majority of the global economic transactions. Okay, it engages in extensive trade relationships as well with multiple countries around the world, not only as an importer but also a massive exporter of goods and services. So changes in the US trade policies and economic conditions can have far-reaching effect on global trade, flows in and flows out really of goods and services. America obviously are not the only ones in that. China will have a big part to play in the overall part as well. When we talk about the S&P as a whole, it is considered an effective representation of the US economy due to the inclusion of 500 companies which cover most US industries. So in contrast to the Dow Jones, which we'll be discussing in a minute, where there's only 30 companies, or for example the DAX, where there's only 40, or the FTSE 100, which is only 100, that can tend to lead to concentration and more of a narrow reflection of the overall economy, as we've touched on. But the S&P does serve as a benchmark for investors as well as fund managers to assess the performance of their portfolio against the US equity market. So as mentioned, when it comes to benchmarking, and you do have a huge amount of exposure in US stocks and you want to know how well you are performing, you would want to compare that to the overall S&P 500, as that will give you a key barometer of if you're outperforming the market or not. Again, with the 500 companies that are listed, it does actually represent 80% of the market cap of a lot of the US equity market. So the companies which are in there, majority of them, over 80%, do a lot of their trade in US dollar. Now, when it comes to the trading hours, these are American Eastern times when the US markets will be open. But here in the UK, for us, it's usually 1:30, 2:30, depending on the daylight saving situation. So American markets are usually open in the afternoon when it comes to us. So you'll have the European Open as well as the US Open, which then tends to lead into the Asian Open after our market closes. So markets are, it's like a clock. There is a market open at every time of the day. Now, the index in itself covers a broad spectrum of industries and sectors, which does include technology, healthcare, financials, consumer discretionary goods. So the diversity makes it a good representation of the overall economy. And that's pretty much what I would like to cover in that. So in a nutshell, when it comes to speaking to clients, you always want to know how the markets will potentially open in the afternoon, any data that's going to be released in the US, how well is the US economy performing, is there going to be any changes to interest rates, how well is inflation coming down. These are all going to be key factors, because if the global market, and especially the US, is improving and maybe they're the first to lower interest rates, that will naturally spur on other economies and other central banks, should I say, in order to lower their interest rates, which could spur markets on even further. And we've already hit all-time highs in all major indices around the world. It'll just give us that next leg higher and keep pushing on and on. Now, looking at the key characteristics of the S&P, first and foremost, market capitalization weighted, just like the DAX, just like the FTSE 100. So these are the largest companies. They have the greatest impact on the index's performance. And as we know, and I will keep reiterating, when it comes to market capitalization, is always the number of shares in issue multiplied by the share price. So just like any other index, there is going to be periodic rebalancing, which reflects the changes in the stock market, and the highest market cap companies will always very much be at the top. So companies can be added and removed from the index based on multiple factors, market cap being one of them. Okay, when it comes to dividends, the S&P 500 is composed of companies from many sectors, and they are known as being a big dividend paying index. A lot of these companies focus a lot on providing dividends. There are always going to be companies out there which focus more on growth than reinvesting of profits. So those are things you're going to have to consider. But yeah, they are traditionally known as attracting investors who are looking for big dividends. Liquidity is naturally generally high. It's important to note that many of the stocks will vary in liquidity depending on market conditions. As we always know, you will always have a mixture of high and low beta companies within the S&P as well. There will be companies which are more susceptible to market information or geopolitical events than others. As well as in a rallying positive market, there are sectors that will be performing well: the financials, the banking, um, the mining, commodities. They tend to do naturally very well. Whilst you'll have the passive sectors, the utilities, food retails, healthcare. They tend to mimic market returns and provide a substantial dividend. Another way of investing within the S&P is always going to be via ETFs and index funds. Um, I've mentioned this with regards to the Dow. So exposing your clients to the US may not always be easy. As I've always said, it's a case of you want to invest in a market or in stocks that you have visibility over, you can react. But the fact of the matter is, when 4:30 comes and the UK, European markets are closed, you are more than likely heading home, whilst the US market is still actively in operation. So it's very difficult to especially trade, but if you are focusing on a long-term play, then that's absolutely fine. You would naturally buy and hold for a duration of months or years. But an index tracker fund tends to be a great way for clients to get exposure to the overall index without having to be actively involved. I think that rounds up everything I wanted to discuss within the S&P. Investors that would look to invest in the S&P, well, they will be your traditional investors. You will be the retail individual investors. They're looking to gain exposure in a broad spectrum of US stocks. So there are multiple different investment vehicles, as I've mentioned. If you're not looking to invest directly, you can do so via index funds, index tracker funds. There's multiple available. You will get retirement savers. You will get investors which are looking for top companies that pay very substantial dividends. That's always going to be one focus. You will have elements of short-term investors as well. So the S&P 500 caters towards every type of investor out there. Institutional investors, not only in the US but globally, will have a huge amount of interest. So, pension funds, insurance companies, they'll be closely linked in order to get broad exposure into these sort of markets. And yeah, they're finally international investors. You and I can invest in the US fairly easy. So you do get a broad range of investors, whether they're for the short, medium, or long term, whether they're looking for dividends, whether you're looking to track the index. Everything is available for every sort of investor. When considering the pros and the cons of the US S&P 500, the main elements will be diversification. There are a broad range of companies and various sectors. So it's a great way of diversifying exposure, especially in the US markets. And it's a great way of spreading risk. The fact that the market is linked to the overall economy is a big thing. It's a great way of benchmarking. So it's often considered a good representation of overall health and performance of the US economy. So if you do see data come out, for example, the non-farms have, when they come out, and more jobs have been created, more people have been employed than the previous month, and the S&P rallies, that's really showing strength in the US economy, knowing full well that more people in jobs create more taxes collected by the government, which will help with increased spending, more funds for government disposal. When it comes to the liquidity, it is very highly liquid, making it easy for investors to buy and sell with very minimal impact on the overall share price or the market price of the index. Historical performance, look over the long term, the S&P has always shown consistent growth, making it a very attractive option for investors seeking, capital appreciation. No matter which way you look at it, markets will always go up in value. They will have slight pullbacks, but the generic trend is always to be long, and for investors to track the market. You can always buy dips, but historically, with more major indices, markets will always go up. Even if we're sitting at an all-time high today, you can come back next month, next year, and barring anything dramatic happening to the markets, we would have created multiple all-time highs by then. Okay, so just always remember the direction of the markets are always going to be up. You will have the odd pullback, but recoveries are always evident. When it comes to the com, look, there is some form of limited international exposure. But the fact of the matter is the S&P 500 multiple, a lot of the largest companies globally are US-based firms, or at least carrying out their operations within the US. So naturally, they are going to have a huge amount of exposure. The fact that there's limited international exposure, you could argue, the market doesn't truly reflect, the largest companies. But look, it is a US market, and overall, there is predominantly going to be US companies. When it comes to market capitalization and the concentration risk, although that the 500 is diversified, it is still heavily influenced by, the largest companies in the index, and it tends to be still the finance as well as the tech sectors, which will drive that index up and down. The market cap weighting, this means that larger companies have a larger impact. It does go down to my concentration risk, as mentioned earlier. The largest companies will always be the ones that, if the market rallies, they tend to do very well. But if the markets are down, there's a strong chance they'll also be very much down. Those are pretty much the pros and the cons of investing in the S&P 500. We will now turn our attention to the Dow Jones Industrial Average, or for short, the Dow. Understand why is it different from the S&P 500, as well as the pros and the cons, and the reasons why it may be a great area for clients to invest their capital. Okay, when it comes to the Dow, some websites will obviously have it as DJIA, or some will just call it the Dow, but it represents the same thing, the same index. It is one of the more widely followed indices in the world. The key difference, though, is the Dow is a price-weighted index, which I'll touch on in a minute, and there's 30 publicly traded companies listed in the overall index. Now, investors as well as finance professionals use the Dow as a barometer, for general market trends, economic conditions, as well as investor sentiment. Movements in the Dow are widely reported and closely watched. But as mentioned in our previous slides, the S&P 500 is the main benchmark. It is the main barometer for the US economy. So any sort of data or news that comes out, every time you speak to your client, you want to make them aware of, what's happening in the S&P. You can make them aware, look, sir or ma'am, we've just had non-farm payroll figures, which came in considerably better than expected. As per the markets, the S&P is currently up over 1%. The reason being investor sentiment is pretty high. This data could suggest that central banks may look to lower interest rates in the next month, which would in essence bring down borrowing costs, which could keep risk very much on in the market. So now might be a great time to shift a portfolio towards maybe a slightly higher beta sector, maybe take more of an active approach rather than a passive approach, restructure the portfolio, maybe getting out of the likes of utility companies, maybe looking at more financials. These are the reasonings why you would want to use the news and the data to your advantage, as it will help you within your pitch and help encourage investors to find a direction. You can devise a portfolio around it. Okay, when we talk about the price weighted index, as we know, with market capitalization, that is the number of shares in issue multiplied by the share price. So with price, in essence, is weighted based on individual stock prices rather than the market cap. So larger the stock price, they will tend to naturally make it into the S&P 500. Each stock will have influence on the index, and a lot of their movements will be proportional. So the way they've come up with the index, they take the average price of all 30 companies, and then they will divide it by a divisor. It will be adjusted to account for any form of stock splits and dividends. So each company will have a pretty similar impact and weight on the overall market. But again, it does come under a lot of criticism, as it's not a true reflection of the leading companies at the end of the day. The market hours for the Dow will remain very much the same as with the S&P, so nothing will change on that front. When it comes to the sectors within the Dow, they're not explicitly divided into multiple different sectors like you will see in other indices: financials, utilities, consumer goods, telecommunications, oil and gas, and so forth. It's the components really are based on the largest companies based on size. So technology companies, they tend to be quite prominent, and they do have a significant presence within the Dow, for example, the likes of Apple, Microsoft. You will have healthcare and pharmaceuticals, so the likes of Johnson and Johnson. Any sort of financial services firms will be the likes of JP Morgan, Goldman's. They tend to have a big impact. And then you will get some consumer discretionary companies, which will include the likes of Walt Disney, Home Depot, companies of that nature. But one thing I want you to make aware of is, I had a look the other day at some of the largest companies in the Dow based on price. And so the top 6 in essence were Amazon, Apple, American Express, Coca-Cola, and Nike. Those were the ones with the largest prices. But when we were to look at the largest market cap, not massively out there, but Microsoft is at the top, followed by Apple, Amazon, then you have Meta, then you got Berkshire Hathaway with Warren Buffett, and then you got Tesla. Okay, so there is not a complete difference, but being price weighted is one thing, but then having an overall market cap is completely different as well. So that's something you may want to take into account. A rebalancing naturally does occur on a regular basis, just like with the S&P. So they would always make sure that the companies with the highest price always tends to make it into the Dow. Liquidity is never really an issue. That there's a huge amount of trading volume. So the more actively a stock is traded, the more liquid it tends to be. And many of the Dow stocks are, they have a very high average daily trading volume. So there's no issue on that front. Market makers play a huge part in providing liquidity, not just with the Dow, but with the S&P and any other global market. So there's a huge amount of attraction within the Dow. It is an index you may look to trade, okay? But if you are looking to invest in companies, it's always best to just really, and most of these companies are going to be multiply listed throughout all the indices. So they can be in the S&P and they can be in the Dow as well. So that's one thing to be very aware of. You will see the same company appear in multiple different indices, but the S&P tends to be the one you want to be keeping a close eye on. But the Dow is heavily reported and worthwhile, keeping your eyes on. But now we'll focus on the pros and the cons of investing or being part of the Dow. Now, we'll always focus on the positives. One of the key points is historical data, tends to play a big part in the reason why investors focus on certain stocks or indices. the Dow's been around since 1986, somewhere around that. It is one of the more older and the more established stock exchanges. So there is that wealth of data and analysis in order to make comparisons. When we talk about the blue chip nature, these are 30 well-established, large companies considered leaders in their respective industries. So you do get that element of stability, and is appealing to many investors. Whether you're seeking volatility or you're seeking less volatility, you can naturally find it. It's an indicator of market health. Obviously, it's not the true benchmark, but naturally, if the Dow is sitting at an all-time high, it's a good reflection that the overall market health and economic conditions in the United States is up there. Okay, so it's a great barometer. It's another reason for backing up a claim. If you speak to your clients and say, look, we should maybe focus on looking at an index tracker fund, maybe of the S&P, and you would need to come up with reasons for that. Why would your reasoning be to track something? Well, one of the reasons could be the fact that interest rates are potentially coming down, inflation is coming down, major indices around the world, global economic health is doing well, and the Dow is also doing very well. So multiple indices are in a very bullish phase, so it would be a great opportunity to benefit from any further upside. But you've got to be aware of any form of cons as well, which we will touch on. Outside the ones that we have here, if you are speaking to investors, you need to make them aware. Naturally, elections are coming up in the US in November. That will have a big impact in which way the market and investor sentiment goes. A lot of that will be policy weighted. What does the current president and the opposition have in store by way of seeing the economy moving forward? So there are many parameters that you would want to consider. But if we look at the cons I've listed, the price-weighted index, it can be seen as a drawback, as it gives more influence on higher price stocks, regardless of whether the company is massive in size. This can result in an index which is not fully representing the broader market performance. That's one way of looking at it. There is going to be limited diversification. There is that concentration risk. There is only 30 companies, as well as them being incredibly well-rounded and large. It's still only 30 companies. Whilst other indices, include a more extensive and diverse set of companies. So it gives you a broader market perspective. That's one way of looking at it. And that's just backed up with the no consideration for market capitalization. It can lead to distortion in the representation of the market, and larger companies may not have a proportionate impact. So a couple of things to be very aware of. Changes over time. As with anything, the Dow Jones does undergo periodic changes, and it can be subject to discretion of the index committee, and it can always work against people or in their favor. So that degree of uncertainty can be seen as a negative. But in the grand scheme of things, it is still a market most analysts will track and provide commentary on. We will now turn our attention over to Asia and predominantly in China. We'll have a good understanding of how their market works, and more importantly, understand their economy and the significant impact it could have on global trade and investor sentiment. Okay, now, so we're going to be focusing a little bit on China, as well as the Shanghai Stock Exchange. The first and most important area I want to focus on is the overall Chinese economy, okay, because it has grown significantly over the last few decades and holds a considerable significance on the global stage. If you are speaking with any form of clients and you're trying to bring them on board and you're trying to convince them on a direction of which way the overall market or the global economy may go, China will always be in that conversation. They are the second largest economy in the world, trailing the United States in terms of GDP, um, and they are the leading emerging market. Okay, they are part of the BRIC nations, the Brazil, Russia, India, China, South Africa as well as the new members that have actually signed up. So, that's going to be a formidable force in the coming decades, and so it'll be interesting to see how that evolves. And if they decide to create their own central bank, it'll be something interesting to behold. Now, when we talk about the size and the growth of China, as mentioned, over the last number of decades, it has really propelled itself in a position where their growth has outstripped a lot of major economies. They are a big manufacturing hub, let's not forget. It has been often referred to as the world's factory due to its dominance within manufacturing. They are a major producer and export of a wide range of goods, whether that be textiles, electronics, machinery, consumer products. They are the largest consumers of all the raw and precious metals. So that's one thing to keep a close eye on. Global trade, when it comes to China, they are a major player in global trade. Um, they are big exporters, they're big importers. So keeping trade relationships with these countries, with this country particularly, is important. Um, but again, we have seen trade wars between the US and China over the last number of years. So that's something to keep a very close eye on. They are very big on investment and capital markets. All that being said, they are changing towards more of a Western outfit. Um, they do have their main stock exchange, the main Shanghai Composite. Um, but again, it's going to take time. It is an increasingly attractive destination for foreign investment by way of capital, but there's still a lot of hurdles that have to be um, overcome. It's a big consumer market as well as a big tech market, but when it comes to their global influence, um, you know, I've mentioned the BRIC nation, and that's naturally going to be the major part of where we see China continue growing, especially with the new members such as Egypt, Ethiopia, Iran, Saudi, the United Arab Emirates. There is a big impact on their global influence moving forward, and there is a huge demand on commodity. So oils, metals, agriculture, um, any sort of change in demand from China will have a significant impact on a lot of these prices moving forward. When it comes to the Shanghai Composite Index, one thing that has to be known is there's always two separate shares. There's going to be an A shares and a B shares listed on the exchange. The A shares are going to be denominated in Chinese yuan, and that's only going to be available for any form of investing and trading for the domestic investors. There will be B shares, which will be denominated in a foreign currency. It's usually going to be the US dollar. That's the only time outside investors can invest on the Chinese markets. So just be fully aware of that. A shares we have no involvement in unless you are a resident. B shares we are able to buy shares, but it will be a case of they're few and far between, and they will be in a different currency. So you do have that currency risk element. But the key part is, realistically, we are not going to be investing in China and through the Shanghai Composite. Okay, the raw fact is that majority of us are going to be asleep. Okay, we will be not able to track it, not able to do anything. One way to have exposure, as I mentioned previously, will be via index tracker funds, especially if you've got a long-term goal and a long-term plan where you're not interested in the day-to-day, intraday fluctuations of the index. That's absolutely fine. But having exposure to emerging markets, whether it be China, Brazil, India, it is essential. You find the right form of ETF. There are thousands out there that you can invest in. But the overall market in China is weighted via market capitalization, so we know the larger companies have a big influence. Um, there is very limited foreign exposure, so it's massively domestically based, so you naturally tend to see quite a huge amount of fluctuations. There are a broad range of sectors. You will get finance, industrials, tech, consumer goods, so they are very comprehensive on that side. But when it comes to the volatility, um, one thing you have to be aware of is China in particular, and their markets are very much retail led, unlike you know the ones we've already discussed, the London Stock Exchange, the New York Stock Exchange, S&P, Dow, DAX, whatever it be. It's institutionally led. The big financial institutions are the main players within these indices, whilst within China they are retail led. If you see a big sell off within retail investors, the market tends to plummet quite dramatically, and in turn there will be circuit breakers which will be in place. And one way to overcome this is to really fund the big institutions within China and tell them just to buy up stock in order to regain some form of stability so investors can actually get back involved. So we haven't seen it for a number of years, but we have seen some dramatic sell-offs within Asia, China in particular, due to the fact they are retail led. But overall, really just focus on understanding the economy, explaining to your clients in the morning when you wake up, China would have closed by then. Understand what happened in the markets, what data came out overnight, why were their markets up or down. That will naturally have ramifications for the European Open. So you want to explain to your client, look, sir, we've just had PMI data which came out of China, which were worse than expected. The composite was down over 0.5%, and in turn, the FTSE 100 as well as the DAX is down over 0.4%. So you want to give them context and reasoning why the markets are down, what made investors want to sell stock, and in turn bring the market down. Is this still a good opportunity to buy the dip? It could be the case that investors were profit taking rather than speculating on a negative market. So it could be an opportunity to buy a dip. There's all these possibilities. So it's about using the information which is coming out of each region around the world and providing that in your pitch. And that's going to give you supportive evidence on why your strategy and idea would work well in a current climate. Okay, now looking at some of the pros and the cons attached with the Shanghai Composite, we'll focus on the positives first. Diversification. The composite in itself does represent various sectors of the Chinese economy, which does include the finance, tech, industrials, as well as others. So it's a very well diversified index. There are a huge amount of growth opportunities. A lot of these companies have a huge amount of potential, especially within sectors such as technology, healthcare, as well as renewable energy. The composite in itself does have a global impact. You know, China's economic growth and market development has a significant impact. So as much as we focus on the US, we need also China to do very well if they continue to grow as the leading emerging market. That will spell good signs for the rest of us. There are a lot of market reforms out there. I have mentioned earlier it's a retail-led, market. There are, reforms in place, and they are trying to develop their financial system, making their capital markets a lot more liberal and having better corporate governance, and make it more open and very similar to how the West operate their market. So it's something that will take time, but it is something that's in the process. And now, when it comes to the currency, you can't trade the yuan, okay? But they are seeking international acceptance and usage. So that developing, it could prove to be a massive global currency if it is regulated the same way as sterling, dollar, euro is, for example. And we have touched on the BRIC nations. By being part of the nation and being obviously the main player, we will see in the decades to come how much of an impact that will have. As you got to remember, most of the countries that are within the BRIC nation, they tend to be all the major commodity providers, whether that's oil, gas, metals. So it could be an incredibly big player moving forward. Now, looking at the cons of um, investing in the composite, volatility is naturally going to be at the forefront, um, especially with a market which naturally is very much retail-led. Maybe not a huge amount of data releases. Government policies are not always fully reported. Rapid price fluctuations can put investors at risk, especially over the short term. Government intervention is nothing new. Government has a history of intervening in the stock market in order to stabilize prices. And this is really to prevent, a serious amount of speculation and just maintain a lot of market stability. The last thing they need is market crashes or massive sell-offs. But this can also distort, market dynamics and can undermine investors' confidence in the long run. So that's something to be very wary of. Limited access to foreign investors. There are a number of restrictions and regulatory hurdles when investing in the Chinese stock market. And especially it's only B shares that you can get involved in. That will be seen as a negative and may put a lot of people off to wanting to get involved. The regulatory risk, as I mentioned, they are looking to overcome it, but any sort of risks of that nature will create a lot of uncertainty for investors as well as for the stock market. So you want to be very careful on how you invest within the region. As I mentioned, tracker funds are going to be your way forward. Currency risks are always going to be evident, especially in the value of the yuan. How does that fare up against the dollar and so on and so forth? That will naturally have an impact on profits and any returns that you will see in the overall index. So clients should always be very much aware of the pros and cons attached to investing in the region. But if they do, these are the benefits and these are the potential cons attached to it. So always make them aware, and that will help you make more of an informed decision.